Alright, so welcome back to another video on how to secure yourself financially, particularly looking at the beginner guide to financial statement. And today I'm going to make a quick recap of what I have learned so far with this section from the sec.gov. In there, they mention that if you're able to read nutritional labels or a box, perhaps a baseball or soccer box score, you can learn to read basic part of financial statement. And if you can follow a recipe or apply for a loan, you can learn the basic of accounting. And the accounting, they're not difficult. They're rocket science. So this section is going to show us how to gain basic understanding to financial statement, much like a CPA course class teach you how to perform basic cardiopulmonary resuscitation. So this section won't train you to be an accountant, just like a CPA course won't make you a cardio doctor, but it can give you some confidence to be able to look at a set of financial statement and make sense of them. So this financial statement, after all, they show you the money. Okay. Uh, so there are four type of financial statement. The balance sheet show what a company owns and owes at a fixed point in time. The income statement, how much money a company spend and make over a period of time. Cash statement show the money exchange between the company and the outside world, again in a period of time. And the statement of the shareholder, which change the interest in uh, show the change in interest of the shareholders in a period of time. So we're going to focus on the first three financial statements in this section, which is the balance sheet, that it shows the company assets, liabilities, and shareholders' equity, where asset is anything that a company owns that has value, and they can be typically be sold or can be used to make product and service that can be sold. So you have tangible assets such as inventory, land, property, machinery, etc. Anything that you can touch, and intangible such as trademark and patent. Cash is another form of assets as the investment that a company make. Liabilities is anything that a company expects to pay to others. There are obligations, such as payroll the company owns to its employer, environmental cleanup costs, the rent for use a building, money borrowed from a bank to launch a new product, tax owed to the government, money owns to the suppliers for material, for example, or any future obligations to provide good and service. And then you have the shareholders' equity, which is also called as the net worth or a capital. So this is what will happen, or what is the money left to shareholders once all of the assets were liquidated and pay off all of its liabilities. So to know how this balance sheet is organized, I look at the formula assets are equal to the liabilities and shareholders' equity, where here sometimes you may find all of the company assets listed on the left side, whereas the liabilities and the shareholders' equity on the right side, or all of the company assets listed on top, followed by the liabilities and the shareholders' equity. And the assets are generally listed based on how quickly they can be converted into cash. So you have current assets, which are things that expect to be converted within a year, into cash, for example, inventory, and non-current assets, which are things that are not for sale, not for sale, or the company doesn't expect to convert that into cash within a year, or it will take longer than that. So here you have fixed assets, which helps to run your business, and then you have the shareholders' equity, with I'm correct, the liabilities, which are generally list based on their due dates. You have short-term or current liabilities, obligations that a company expects to pay off within a year, and long-term, more than a year. And the shareholders' equity, which shows the money that owners invest in the company's stocks, plus or minus the company earning or losses. And sometimes companies redistribute this earning and they call that dividends. So the TLDR is that balance sheets, after all, they show you a snapshot of the company assets, liabilities, and shareholders' equity at the end of a reporting period. So you have this annually or quarterly most of the time. But they don't show you the flows in and out of the company. So income statement, which is another statement, it shows you how much revenue a company made and the associated expense and cost with earning that revenue in a period of time, quarterly or annually, most of the time. So the bottom line of this statement, it showed you the company net earnings or losses, how much money a company made or lose. Also here in this statement you have something called the EPS, the earnings per share. It's a calculation that where will be the amount of money if the company redistribute all of its earnings to the shareholders. Typically they don't do that. Almost never they do that. In fact, they reinvest that in the business. So to understand how income statements are set up, here we can think of them as a set of stairs, where you start at the top with the total amount of sales made from product and service, and once you go a step at a step, you make a certain deduction or cost associated with earning that revenue. And at the bottom of the stair, you reach at the company net earnings or losses to know if a company actually made money or not. So now looking at the specific, it all starts with the uh, gross revenue, aka the total amount of sales made during an accounting period for product and service. Once you go down the step, there are certain costs and expense that a company does not expect to collect. For example, sales discounts or merchandise returns. So once you subtract the merchandise return and the allowance, this money that you don't expect to collect, okay, for example, like sales discount uh, or any other money that you don't expect to collect that you give up to something, because after all, allowance can be depend on the context. Is the amount of money that you give to someone, perhaps the parent to the child, uh, or a help that you might give to someone. So once you subtract this return and allowance from the gross profit, then you arrive at the company net revenue. And you can think of that as a net because the revenue are left in the net after deductions from allowance and merchandise return have come out. Then you have a series of deductions or a series of expense. But typically, after the net income you have is the cost of sales. So how much money a company spend to produce the good and service uh, they sold. So once you subtract the cost of sales from the company net revenue, you arrive at the gross profits. And they call gross because there's some deduction or there's some expense that have been not deducted from it yet. So the number is unrefined. That's the reason what they call gross. So gross profit. After that, the next section deals with operating expense or expense that go toward to operate your company, such as administrative salaries, the cost of research, new products, marketing, and they cannot be linked to the cost of sales because they are not directly correlated to the productions of good and sell or products, good and service uh, to the company, right? They're just allow these are expenses that allow supporting the company's operation. So then you have his depreciation, which takes into account the wear, the amount of use and tear, the damage of certain assets such as machinery, tools, and equipment, which the period they were used, or the period which they will use over the long term. And this type of assets, okay, or spreading the total cost of these assets over the period they've used, this spreading of costs is called depreciation. And the basic example of calculate that is, for example, if you buy, this is also highly contextual from the economy, right? Different nation economy. But overall, this is something that, for example, if you buy a laptop from, let's say, 100 or 1100, okay? And then you deduct, for example, 100 depreciation. This is a calculation that may vary. Let's say you assume that calculation. You're gonna deduct 100 from the total value, and then you divide it by for the num. Then you divide it by the number of useful years. Then you arrive at the amount that you should deduct yearly, right? So this is also known as the straight line depreciation, right? Again, this is one way to calculate. So once you deduct the operating expense and depreciation from the gross profit, then you arrive at the income from operations before interest and before interest and income tax paid. So this income or income, interest income and expense. So the interest income is the amount of money that a company made for keeping their cash in saving accounts, for example, money market funds, which are involve the purchase of a large volume of very short-term debt products such as overnight reserve or commercial paper. So they should be used, according to Investopedia, as a place to park money before uh, making the investment or investing in elsewhere or getting or or making an anticipated cash outlay, and they are not suitable for long-term investment. So this money market fund, also known as debt-based financial instrument, they invest on short-term debt from banks, also no bank acceptance. Uh, they also invest on savings certificate issued by banks with short-term maturity, or also called certificate of deposit. Commercial paper, this unsecured short-term company debt, and repurposed repo, repurpose, repo, mhm, money market, money market fund. That's right, and repo, and money market fund. Mm, a repurchase agreement, repur, short-term government debt issues. So again, this is something interesting because now as a company you have this financial instruments where they should be used as a place to park money before investing elsewhere or making an anticipation making an anticipate cash outlay. All right, cool. And then you have interest expense, the interest expense, which is the total money that a company owns for more money for borrow money. And sometimes you might find this interest income and expense separately or together. And once you subtract or add the interest income and expense from operating profit or income from operations, you arrive at operating profit before income tax. And finally, income tax is deducted and you arrive at the bottom line. Okay? So finally, income tax. Yeah, finally, income tax is deducted and you arrive at the bottom line. Net profit or net losses. And net profit is also called net income or net earning. So once you deduct or once you subtract or add the income in the interest income and expense from the operating profit, you arrive at the operating profit before income taxes. And finally, you deduct the income tax and you arrive at the bottom line, the net profits or net losses. And so net profit is also called net income or net earning. And this tells you how much the company actually earned or lost during the accounting period. So did the company make a profit or did it lose money? They mention here the earning per share, okay? It's a calculation that tells you how much money the shareholders will receive for each stock they own if the company distributes all of its net income or net earnings, net profit. So to calculate EPS, you take the total net income and divide it by the number of outstanding shares of the company. And that is cool, that's awesome, because now that I know how an income statement is set up, then I look at the cash flow statement. So cash flow statements report a company inflow and outflow of cash. Important here. So cash flow statements report a company inflow and outflow of cash. This is important because company need to have enough cash on hand to pay this expense and purchase assets. Two things important here, right? So the cash flow statements report a company inflows and outflow of cash. And this is important because company needs to have enough information. This is important because company needs to have enough cash on hand to pay this expense or liabilities, to pay this expense and purchase assets. While an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generate cash. Interesting. So cash flow statement show you, or the cash flow statement can tell you whether the company generate cash, whereas the income statement show you how much revenue or how much profit or loss a company made. Okay, a cash flow statement show change over time rather than absolute dollar amount at point in time. And a cash flow statement should change over time rather than absolute dollar amount at a point in time. It uses and reorders information from the company balance sheet and income statement. Okay, it uses and reorders the information from the company balance sheets. Okay, total amount, or yeah, the company balance sheet that after all show the how what are the things that a company owns and it owns at a fixed point in time, and how much revenue the company made or how much profit a company made. The bottom line of the cash flow statement show the net increase or decrease in cash. Okay, so it shows you the net increase or decrease in cash for the period. Generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of the three types of activity. Okay. Operating activities, investment activities, and financial activities. So when I look here at the Coca-Cola here, okay, and I want to now look at their cash flow statement like this. Okay, so cash flow show or cash flow can tell you where the company generate cash. Okay, so the cash flow statement show the company inflow and outflow of cash. And this is important because company needs to have enough cash on hand to pay this expense and purchase assets. While income statement show, or while income statement can tell you whether a company made profit, a cash flow statement can tell you whether the company generate cash. And it's important to make this distinction because yes, an income statement can tell you whether a company made profit, can tell you that, And the cash flow statement can tell you whether the company generate cash. And the cash flow statement show change over time rather than absolute amount of volume. Show change over time. Show change on the and the cash flow statement can tell you whether the company generate cash. And cash flow statements show change over time rather than absolute dollar amount at a point in time. It uses and reorder the information from the company balance sheet and income statement. It we use information from the balance sheets and the income statement. But again, it show change over time. It show change over time. Again, it show change over time. If, for example, Coca-Cola might receive some asset like this. Operating cash flow, investing cash flow, financial cash flow, and end cash position. Capital expenditure, insurance, operating and investment and financial cash flow. So the bottom line of the cash flow statement shows the net increase or decrease in cash for the period. Generally, cash flow are divided into three main parts. Each part reviews the cash flow from one of the three types: operating activity, investing activities, and financial activity. But the recap of cash flow, okay, is that cash flow statements show the company inflow and outflow of cash. And this is important because company needs to know the company needs to have enough cash on hand to pay its expense and purchase assets. So while an income statement show where an income statement can tell you if a company make profits, a cash flow statement can tell you whether a company can tell you whether the company generate cash. Okay, and a cash flow statement. Yeah, and a cash flow statement show the change over time, like this. Yeah, and a cash flow statement. Okay, and a cash flow statement show change over time, rather than absolute amount of dollar, rather than absolute dollar amount at a point in time. So the cash flow statement show change over time, change the inflow and outflow of cash over time. And it used and reordered the information from the company balance sheet and income statement. And reorder and it used the information from the balance sheets and income statement. And at the bottom line of the cash flow show the net increase of the or decrease in cash for the period. Generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of the three types of activities: operating activities, investment activity, and financial activity. So the TLDR of cash flow statement is that shows the uh, company inflow and outflow of cash. And this is important because company needs to have, okay, enough cash to pay expense, enough cash to pay expense and purchase assets. If you see yourself as a company, yes, you need to pay expense, rent, service, food, and purchase assets, perhaps to operate your own business. So while an income statement can tell you whether a company made profit, a cash flow statement show or a cash flow statement can tell you whether a company generate cash. And the cash flow statement shows change over time rather than actual dollar amount. It's change over time. Wow. Holy shit. It was a horrible year. Operating cash flow. Mm, okay, so a cash flow statement shows the change over time. Okay. A cash flow statement shows the change over time rather than the absolute amount, dollar amount at a point in time. And it views and reorders the balance sheet uh, and the income statement. So, and use and reorder the data from balance sheets and the income statements. And the bottom line of the cash flow statement show the net increase or decrease in cash for the period. Typically, as the income statement that show you how much money the company made or lost. Okay, the net profit. Okay, the bottom line of the cash flow statement show the net increase or decrease in cash for the period. And generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of the three type activities. Okay, so now cash flow, similar as the income statement where we saw how this is set up. So cash flow can be divided. Cash flow statements are divided into three main parts. Each part reviews the cash flow for one of the three types of activities: operating activities, investing activities, and financial activities. And with that, that'll be all for this video. Take care. Bye bye.